This is a video on a useful degree of accuracy in valuing stocks. It's brought to you by PolarisInvesting.com, a site for creating defensible valuations. If you recall, valuation is a craft requiring skillful balance of past facts with future possibilities. The introductory slide to this topic is demonstrating that with any topic, it's often advantageous to shave off some of the rougher edges around the topic and to end up with something much easier to work with. Typically, when you do that, the trade-off is some minimal, hopefully minimal loss of accuracy. And this brings up the distinction between accuracy versus precision. I want to make sure we are in sync on these two concepts. Precision is about the number of decimal places in a value, whereas accuracy is about repeatability and closeness to true value. Take, for example, weighing yourself. If each time you step on the scale it reads the same number of pounds but slightly different fractions of pounds, then the scale is accurate but only precise to a pound. Ideally, you want an accurate measure to the required level of precision. This discussion is about accuracy and not so much precision. To get started discussing useful degree of accuracy and valuation, let's review the basics of the valuation of an investment. Here at the top, showing discounted cash flow of an investment in general. You, the investor, are earning some return based on a price you paid for investment over a period of time, in this case in years. And that present value of that represents an annuity. Then at the end of the period, you hope to get your investment back, and then you discount that back, and V&N represents discounting back for in years. So this is, in general, how an investment works. You earn over a period of time a return on investment, and then eventually you hopefully get a return of your investment. Straightforward example of a type of investment that fits this type of cash flows is a bond. And a bond, you receive a coupon payment, which is typically expressed as a coupon rate, which is what R represents in this formula. And then the face value is the purchase price. So you receive coupon payments over the life of the bond. Then at the end of the bond, as the bond matures, you receive the face value of the bond. Now, this type of investment, general investment, and particularly a bond, can also be expressed in an alternate formula where you take the price of the bond times the investors' return on investment that they're receiving on a quarterly or yearly basis, and then subtract off the risk-adjusted expected rate of return based on of the cash flows, based on the riskiness of the cash flows, which is set by the overall market. That difference represents an annuity stream. Add 1, and these are equivalent expressions. Leave it up to you to determine that they are equivalent. It's available in a lot of investment books that show this relationship. Well, the nice thing about this alternate formula is it lends itself to very straightforward interpretation. And that is as if the market conditions change for as it relates to a particular bond, and now the riskiness of those coupon payments have gone up. That implies that the cost of equity, which I'm using the term cost of equity here just to be consistent with the use of a similar concept later in the presentation, but we'll call it this cost of equity here. So it would go up. And so when you subtract the coupon rate minus that now increased riskiness level, you get a negative amount. And then when you do the math, you end up with a valuation that's less than the purchase price, which means the bond is selling at a discount. If the coupon payments become more certain, less risk involved, then the cost of equity number drops, and now you end up with a positive value out of this first term, and therefore the overall valuation increases, and now the bond is selling at a premium. This COE value is relative to a bond is typically referred to the bond's yield. Well, the basic valuation formula that we just went through is ideally suited for a bond, because a bond has a fixed return or coupon rate on its investment over a specific period, followed by a return of investment equal typically to the face value of the bond. Now, stocks are different than bonds in that there is no fixed maturity. The recurring cash flows also are not fixed like they are with a bond. And then lastly, there's no contractual amount to be returned from the investment like there is with the bond with its face value. So relating the general investment formula to a stock, you can just think of the R varying by period, and that the N goes on forever. So when you value or do a discounted cash flow valuation of a stock, you need to do each cash flow separately, because again they're not the same, they're not consistent. So you just discount each cash flow separately by the market adjusted risk adjusted rate of return. Well, because there is no maturity and time it goes on forever, what's practically done is when you do a discounted cash flow for a stock, is you break it up into the near-term cash flows, and then calculate what's referred to as a terminal value, sometimes also referred to as continuing value, for cash flows that extend beyond the near term. The main reason for breaking cash flows up into near term and beyond near term is that it's just not practical to forecast cash flows beyond a certain time, because after several years your forecasting becomes cloudy enough that it's just not practical to think that the forecasting is very useful beyond a certain point. So you have to cut it off after a while, and then we'll be talking about this terminal value calculation later in the presentation. I do want to back up and just point out that Polaris investing site uses 5 years for the near-term cash flows. And then in the terminal value period, which is the period after the near term, it makes an assumption regarding the rate of return earned by the investment and the risk-adjusted rate of return. Essentially, it says they're equal. And when they're equal, this term here in the general formula that applies mostly to a bond, but it's clearly seen that if you assume that they're the same, then this equation just calculates to the price. Now, since we're breaking things up into the near term and beyond the near term, this price is actually the price in the future. In the case of Polaris, it would be the price 5 years out. So we'll be talking about how that price is determined in 5 years. But the math involved in terms of how you do the present value of cash flows beyond the near term is greatly simplified if you assume that things mean revert, which means that this R eventually gravitates to the market's risk-adjusted, expected risk-adjusted rate of return. Let's look at how an analyst will typically approach a valuation exercise. Now, I know this is looks like a pretty involved table, but just going to briefly go through it. I want to point your attention that it's broken up into really 3 main sections. One section deals with historical data, and then the next section deals with the near-term cash flows going forward, And then there's a third section here that deals with what's referred to as stage 2, but that's the period beyond the near term. So what an analyst does is they do a pro forma income statement where they look at the past sales and assume some sales growth. Now here, for consistency with what we're going to be going on later on, assuming a constant sales growth of 7%, but there's nothing that prevents the analyst from having a forecast that has a varying sales growth from year to year. But some forecast is made about growth of sales. Looking at past, some normalized value for sales is calculated, and then the sales growth is applied to that. Then an operating margin is calculated, and from that you get a net operating income, subtract taxes. You look at what the reinvestment needs are going to be that year, typically based on some ratio of past sales to how much capital was required. Then you look at how much additional sales is being forecasted and apply that ratio. But again, you look at history to get some idea of what likely will be the capital requirements as sales change going forward. And then you end up with, at least in this way of doing things, you end up with what's called a free cash flow to the firm, and then you discount back these values for the first 5 years, and then we'll be talking about more how you determine the terminal value here later in the discussion. Well, I want to go back and look at basics of accounting so we can kind of get a clear picture of what we just did there. Real quickly, so refresher, make we're all synced up on just our basic accounting. Is it sales minus accrued costs associated with products that were sold during the period, which is called cost of goods sold. You end up with gross profit. From there, you subtract off a period costs, and then you end up with operating income. From there, subtract off the debt payments, any income or any interest that was earned on money market accounts, things that are outside operations of the company. And then you end up with earnings before taxes, subtract taxes off, you get net income, also known as net profit. Management makes a discretionary decision about amount of dividends to pay, and then what's left over is moved onto the balance sheet as retained earnings. So what we're going through in the chart about how the analysts do their valuation, we've taken it down to the operating income. But there's no reason that it had to stop there. We could have kept going through and done a pro forma that also included expected debt payments, any interest payments from non-operational investments, and it gone all the way down to the income statement. So if we go back and look at that, we would have end up with something called free cash flow to equity versus free cash flow to the firm. And I'm not going to get into, because of the length of time of this video, I'm not going to get into the discussion, the trade-offs between one versus the other. Suffice to say, there's just two ways you can do it, and if you're aware of things to look out for each approach, they should result in equivalent valuations. Now, in this valuation, using free cash flow to the firm, I want to point out here that at the bottom, we end up with a total value of the company, and we compare that to the terminal value portion of the valuation. You notice here the terminal value ends up being almost 90% of the total valuation. Well, that's a fairly normal thing, regardless if you're doing free cash flow to the firm or free cash flow to the equity holder. That percent of terminal value as it relates to total value is fairly consistent. Maybe not as always high as 90%, but it's typically 85, 90%. And we'll be showing that, I will be going into that in a little more detail, but to show that that's typically true. I also want to point out that how far you go down in the income statement with your pro forma cash flow determines the discount rate that you use when you do discounted cash flow valuation. You can see here that if you take it down to free cash flow to the firm, you're stopping off at operating income. So the operating income needs to be divided up between both the equity holders and the bond holders. Whereas if you continue go down through the income statement and subtract off your debt payments, you end up with what's the net income that's left over for just the equity holders. So then you would be discounting based on the cost of equity. So in this example of how analysts do cash flow analysis, since it is assumed free cash flow to the firm, we need to calculate what's called the weighted average cost of capital. It weights between both debt holders and equity holders, and ends up with a discount rate that's applied in order to calculate the discounted cash flow. Again, if we would have taken it down to free cash flow to the equity holders, we would have just used cost of equity as the discount factor. Now, another thing I want to point out while we're looking at this table is it goes back and revisit this line here about reinvestment. And this happens to use a ratio of past capital per amount of sales to forecast a future likely reinvestment. But reinvestment specifically is the amount of additional fixed assets like property, plant, equipment, things like that, that will be required to support the changing sales. But it also includes variable additional expenses that will be incurred dealing with working capital. So this has to do with accounts receivable. As you sell more, you're going to incur more accounts receivable. Inventory, likely will need to have larger inventory. Now, some benefits of increased sales is that your accounts payable will go up, and that will actually decrease the amount of overall working capital that you need. So you got to account for increased property, plant, and equipment, and also this change in working capital, which is accounts payable plus inventory minus, or accounts receivables plus inventory minus your accounts payable. But in this table, that's being estimated through this ratio that's being used. The other thing I should point out is the operating margin, just make sure there's no confusion there. That operating margin is just simply looking at cost of goods sold and all these period costs and coming up with a ratio that's applied to the sales. So it's just another way analysts use to represent what the expenses that they expect to be incurred going forward. This approach in valuation that's used by most analysts is the most accurate way to do a discounted cash flow analysis. But it requires a lot, it's very meticulous, and there's a lot of very explicit values that have to be forecasted, and the more forecasting that's done, more numbers used, the more opportunity there is to make mistakes along the way. But before we leave this, I want to just make sure we realize that through all these numbers, the one that really makes the most difference is the final cash flow that goes into the terminal value, because the terminal value represents such a high portion of the total valuation that this number is really the critical number. So if we can come up with a way of estimating that one number, we can sacrifice a little bit of accuracy of doing this kind of a detailed analysis and use a formula to calculate this final cash flow and then feed that into the terminal value calculation. Let's go back and recap briefly kind of where we're at here. Is we start off with this general formula for an investment, and then we said it's ideally suited for a bond. We just said for a stock, the differences between a stock and a bond are such you have to consider each cash flow separately. And we said as we consider those cash flows, it's just impractical to consider every cash flow. So we broke the cash flows up in the near term and beyond the near term and calculated a terminal value for that. Then we just went off and looked at how analysts typically deal with this near term versus beyond the near term in terms of explicit cash flows. Well, next I want to talk about is whether that there is a technique that we can create a formula instead of doing these explicit cash flows. And showed that earlier that with the explicit cash flows, we assume a constant growth of sales and some other things like a constant operating margin and even a constant reinvestment rate, that we can create a formula that represents this near-term cash flows. Well, one version of that formula is shown here. I'm not going to go through this formula, but this is provided by Dr. Damodaran of New York University, well known in the field of valuation. This is a very involved looking formula, but it's actually fairly straightforward if we just do a little simplification of how the formula is written. So that's what I've shown here here is that it's the equivalent formula, just slightly rewritten. So let's go through what the interpretation here of what is really going on is. We simply have the first term, which is the near-term cash flows, and then the second term is the terminal value. So let's go back to the first term. The first term says you take a starting cash flow and you essentially let it run forever, which hopefully most people watching this video are familiar with the Dividend growth model, those kind of models. They assume a perpetuity of cash flows, and then there's a geometric progression, and you end up with an expression like that in the denominator that reflects a perpetuity cash flow. But here in the numerator, what we've done is we've subtracted off after Y years, and Polaris uses 5 years, but we subtracted off everything that kind of goes on beyond 5 years. So that's all this is doing. Is it's a perpetuity stream of cash flows that subtracts off, that you subtract off the perpetuity after 5 years. The second term of this formula has a similar looking format. It's just that it omits the 1 minus portion. So what it's doing is the same thing. Is you have a perpetuity cash flow by virtue of the denominator. But here in the numerator, you don't subtract off anything. What you're really doing is you're delaying. This term just simply says, starting 5 years from now, we start up a perpetuity that lasts forever. Now, starting cash flow that's used both in this first term and also in the second term is based on the bottom of the income statement, namely earnings. So this is free cash flow to the equity holder, whereas the table that we showed how an analyst does explicit cash flows is based on free cash flow to the firm. But here we are with at the bottom with earnings. Then what's done here is you multiply earnings by 1 minus called the reinvestment rate. What you're left with when you multiply those together is how much is being distributed to the stockholder. Now, typically the form of distribution that we all think of is a dividend, but studies have shown that typically across a broad range of companies that the average distribution to a stockholder consists of not only the dividend but also buyback are the two main forms. Now there's a third form where a company chooses not to distribute the money but rather keeps it in a money market on its in its non-operating asset, but it's there kind of earmarked for eventual stockholder, so indirectly it is owned by the stockholder when it's not used for operations. But we're going to focus on the two types that are actually distributed back to the stockholder, namely the dividend and also a stock buyback. Well, these studies have shown that particularly for a mature company, the typical buyback is about equivalent to the amount that's paid out as a dividend. So if we assume this distribution is 2 times the payout, then the reinvestment rate is 1 minus 2 times that payout for a typical kind of just guideline or general rule. So now we have all the information here to calculate a discounted cash flow in general for a company. Now, if you're going to make a real buy-sell decision based on a discounted cash flow, you would not want to use this rule of thumb. You want to be specific about what the, you want to be exact, a little more exact about how you calculate the starting cash flow. So what you do is you would take net income, and then you would go back to the definition of what free cash flow to the equity holder is, and that's net income minus any new investment that is expected. Then you subtract off any change in working capital, and then unlike free cash flow to the firm, you add net debt, which does not include the interest payment on debt, because with free cash flow to the equity holder, you already passed that in the income statement. Rather, net debt is the difference between any new floated debt minus any debt principal repaid. One other thing I want to point out is EPS 0, which is earnings per share or net income at time 0. The 0 also implies normalized earnings. Because all follow-on cash flows are derived from this value, I want to make sure that this being used is what they call a normalized earnings, meaning that it excludes any one-time events that maybe cause that specific year's earnings per share to spike up or to be much lower than it would normally be. So you want to make sure you're looking and excluding one-time events and end up starting your cash flows with a representative earnings per share going forward. Now, if we go back and assume this general guideline for what reinvestment is, we have all the terms move forward and now calculate a discounted cash flow. But before we do that, or go further into that, I want to talk about the formula itself. And if you look at it, it presents itself as a fairly involved calculation, and therefore you feel like you're likely going to get a fair amount of accuracy out of this formula. But the reality is it's kind of false accuracy. There's a lot of assumptions that went into this formula, and what comes out of it has given up some accuracy from the detailed cash flow analysis that analyst does. So going back to this concept of useful degree of accuracy, we have a less degree of accuracy. We've chiseled off some of the rough edges or around doing a detailed explicit cash flow analysis, but we've ended up with a formula that's easier to work with. We just plug in values and allows us to move forward and do more what-if type analysis using the formula that we've derived so far. But again, it's not the same thing as the actual explicit cash flows. So it's not as accurate, but it's still pretty accurate. But a problem with the formula is it ends up using a lot of several terms that are just not familiar with typical investors. You're dealing with things like payout, reinvestment rates, normalized earnings, growth rates, cash flow. It's just terms that typical investors are not familiar with, and even if some are, by the time they come back and do another valuation, they've forgotten the terms, or they've mixed them, and before long they're introducing errors in future valuations that cause some erroneous buying and selling to be done. Next formula shown here is an equivalent formula for this more complicated formula we just went through. And the big difference between the two, even though they produce the same result, is that the first term accounts for just the dividend over the next 5 years. Again, 5 is what's used by the Polaris site. And then the buyback portion that was included up here in the formula above is now handled in this future shares calculation in the second term. Also here in the first term, there is no accounting for growing of the cash flow, in this case dividend, and discounting it back. And what we're going to be showing here shortly is that mathematical operation of growing a cash flow and discounting it back essentially cancel each other out. So this total formula, I said earlier, equals the previous formula. Well, that doesn't exactly equal, but it's very close. There's very little inaccuracy introduced by not growing and discounting back. So back to the picture, all we've done here is to go from that more complicated formula to now the formula that Polaris uses, is we just shaved off ever so little, maybe relative to all the other chips that are on the ground here, maybe these last two chips, just chipped off a little bit more and ended up with a much smoother, easier to work model going forward. So let's back up and do this a little more exact formula and see what we get when we vary some of its input values. And so that's what this table is it's broken up into three sections. This first section here, and then it's just that section is repeated two more times, and all we're doing is varying the payout ratio that's assumed throughout this section of the table for three different times. So within a given section of the table, just varying the three major inputs, and then calculating a terminal value, and then the near-term cash flow value. So when you add in the table these two, in any given row, these two columns together, that is the total valuation that's being assumed given these input parameters. Well, also shown is another column that just compares if you just would have taken 5 times the dividend, and what different value would have you gotten relative to the full up growing and discounting of cash flows. And you can see here that like this first case, we would have ended up with a present or a value for that first term that would have been about 4% higher than the actual growing and discounting. Another example, if we skip down here, if we just would have taken 5 times the dividends and compared it to the growing and discounting the dividends, we actually end up with only 0.74% of the actual number. Well, we do that for all these different combinations across the 3 different sections of the table, and then average up what the overall difference is between this 5 times the dividend versus growing and discounting back, and we've determined that the average is 95%. So you're only introducing about a 5% difference in that value on any given row. 5% difference by just taking 5 times the dividends. Now, if we look further, we see that the even when we do grow and discount back, the percent that first term represents is a very small percent, less than this first case here is about 80 or 12%, which means 88% of it is in the terminal value, and we do that across all the different combinations, and then add up the total or average it out when we get an average of about 15.8%. So on average, the continuing or terminal value accounts for 85%. Then the last thing we've done is it says, well, what's the difference in valuation if we would have just 5 times the dividends versus growing and discounting the dividends? And we do the same thing, do that 3 times, or for all the combinations of inputs. Realize it introduces a very small overall error by just taking 5 times the dividends. And that's primarily because of 2 things. The difference that we typically see just by taking 5 times compared to growing and discounting is not that big, but also because the percent of the total valuation that first term even represents is pretty small. Well, what's been discussed so far is just the impact of excluding the growing and discounting of cash flows in this near-term period. But this formula used by Polaris also moves the handling of buybacks, which is actually why this became 2 versus 1 when we came up with a general form of the reinvestment rate, is it moves it to the second term. Well, we can do a quite quick change here to an input parameter into this table, and what we've just done here is we've now accounted for that second change as well between the more complicated formula and the one used by Polaris. And we see here that when we move the buyback portion into the second term, we make the terminal value even a bigger percent of the overall valuation, and therefore the first term becomes even smaller. So we still have the same error introduced in the first term of about 5%, but the overall percent that the first term represents smaller, and therefore the terminal value represents on average almost 92% of the total valuation, and so the error is now almost 0. So where that leaves us is with the Polaris formula that's essentially equal to the more complicated formula, but it's much easier to understand. The first term, you just take the current dividend, multiply it by 5, and that gives you the dividends that are received over the next 5 years. The second term, you're just taking current sales, you're growing the sales for 5 years because y equals 5, and then you end up that whole portion of the formula results in future sales. You take future sales times a forecasted future profit margin, and when you multiply those two things together, you get future earnings. You take future earnings times a future forecasted profit or price earnings multiple, you get future capitalization, which is price times the outstanding shares. You divide that by the anticipated number of future shares that it does include buybacks, and now you end up with a future price, and then you just discount it back 5 years, and you get a present value. Add that to your dividend, and that's your valuation. Now, the formula used by Polaris, again, not only doesn't include the growing and discounting of near-term cash flows, but it also moves the handling of buybacks into the second term of the formula. So if we omit that moving of the buybacks into the second term momentarily, and you do that by just assuming future shares is equal to current shares, it can be shown that the second term here in the formula used by Polaris is exactly equal to the second term in this more complicated formula. And the way that I want to just prove that that's true, and the way you do that is that you need to realize that a PE multiple that assumes constant growth, it can be shown to be equal to this expression here. So when we go up into the second term of this more complicated formula, we can dig out those terms. We have 1 plus the growth here, and then you have, because earnings, the starting cash flow is this earnings times 1 minus reinvestment rate. We pick up those terms in the starting cash flow portion of the term here in this formula, and then the perpetuity portion is right here. So there's the PE, and that's just being represented in this formula as this future PE. Now, before I leave that, I do want to point out that Polaris goes a step further and assumes that the cost of equity equals the rate of return that's built into the growth, and then when you do that, you end up with even a further simplification of what the PE, of how to calculate the PE. It's just the future cost of equity into that stream of cash flows beyond the near term, 1 plus that divided by the cost of equity. All right, so there's the PE term, the future profit margin times the sales growth. This gives you future earnings, and that's showing up here that you take earnings, and we've already accounted for the 1 minus reinvestment in the PE, future PE calculation. So you take the earnings and you grow it by using this term here to the fifth term, and that grows earnings to future earnings. Then the only thing that's left, since we're assuming for now the future shares equal current shares, is you discount it back, and then that discounting back is occurring here in the expression in this more complicated formula. Well, this formula used by Polaris is quite the result, considering how simple it's become and familiar terms that it uses. Again, dividend, current sales, profit margin, price earnings multiple, share count. These are common accounting terms built around earnings used by investment world when interacting with retail investors. Well, one of the big simplifications is that we were able to take buyout, the handling of buyout out of the first term from this more complicated formula into the second term through forecasted expected future shares. Dr. Damodaran discusses this idea in his blog dated July 2018. He clearly shows that an alternate way of handling buybacks is excluding them from the cash flows and instead incorporating them through a forecast of the number of new shares that would be required to cover the buybacks. So where that leaves you is now you need to have a way to forecast future shares. Well, if we go all the way back and show what analysts typically use in terms of their explicit cash flows, remember we talked about when you're doing at least free cash flow to the firm, the analysts use this thing called sales to capital ratio to help them determine a forecasted reinvestment needs. Well, similar to that, Polaris forecasts future shares by calculating a sales to equity ratio. So not a sales to capital ratio. Capital would be both debt and equity requirements. But here we just do sales to just the equity requirement because the formula is based on free cash flow to the equity holder. So what we end up with is a very simple formula where all the values are readily available in terms, or they can be forecasted defensively. And you end up with a focus on more on the second term, because now this first term, by taking the buyouts out and again excluding the operation of growing and discount, you end up with a first term that is relatively insignificant compared to the second term. Only around 9% or less of the total valuation is in the first term. Since originally recording this video, 2 additional input sliders have been added to the Polaris Investing website, namely the future profit margin slider and the future price earnings multiple slider. The remaining portion of this video assumes only the sales growth slider exists. Thus, the future profit margin and future price earnings multiple must be indirectly entered through the sales growth slider. If you're interested in understanding the impact of using the sales growth slider to indirectly enter the other values, you should watch the remainder of the video. Now there is another aspect of useful accuracy as relates to this formula, simplified formula that Polaris Investing uses. And it has to do with the approximation error of using the sales growth slider to indirectly enter users' different opinions about other input values into the formula. So I'm going to focus on the profit margin. Let's say that a user, or the default value shown by Polaris is 12% profit margin, but you as the investor using the Polaris Investing website think that 15% is more reasonable profit margin to be using. Well, that represents a 25% increase in the ratio of the profit margin. So like is shown in other videos, you would go out to the Polaris Investing website and you would say, okay, I'm going to increase the theoretical valuation by 25%. So you just come over here to the sales growth slider and you indirectly enter the impact of a 25% larger profit margin by just moving the sales growth slider until you see about a 25% change over the default, which takes you up to something around 90, 95 or so range. It's not about getting it exact, so we move it to around 93, and then you see what the impact is to the practical valuation, and then eventually the expected investment return from a practical standpoint, and that's what you would go forward with to make your investment decision. Well, let's go back and look at the real impact of the formula is by making that ratio 20, and therefore the valuation 25% larger. You're actually multiplying that ratio of 25% not only by the second term but also by this first term. But the first term has been shown to only be, 8-9% of the total valuation. So the total error and accuracy that you're introducing by that method of indirectly entering a change over the default value for one of the other inputs besides sales, it's pretty minimal. It's just 8% times, let's say in this case, 25% difference increase in profit margin. It's 25% times the 8%, which is only 2-3% total change in valuation. So even with a fairly significant change to an input value that you're entering indirectly through the sales growth slider, still only introduces a very, very small error into the total valuation. So when you consider what the total error is between this first term not accounting for growth and discounting back of cash flows and moving the payback or purchase stock repurchase into the second term through future shares, and now combined with this potential changing of a input value indirectly through the sales growth slider, the total error is just really nothing for the first case of growing and not including growing and discounting. As we showed earlier, that's really almost 0%. And so the second one we just went through introduces about, a 3% error. So the total error or inaccuracy that's introduced by not using this more complicated formula is just a 2 or 3% loss of accuracy. So when we go back and look at the graphic we've been using, all we've done is we've just shaved off very little off the the model, and for that little bit of inaccuracy that we've introduced over the geometric model, it makes the model resulting formula much more straightforward and allows you to really focus on what's important, and that's primarily the second term, which represents the terminal value, and then very little thought needs to be given to the first near-term cash flows, because that's just the dividend times 5. Now, I did mention there would be at most a 2-3% type error in accuracy, but then it raises an interesting question about, when we say error in accuracy, it's relative to this more complicated formula, but that more complicated formula really represents an attempt to in a formula calculate the present value of near-term cash flows plus the terminal value. But as we showed, analysts prefer to do that through these very explicit year-by-year cash flows. So when we say error and accuracy, we've already got a little bit of error and accuracy over the analyst approach. So who's to say that this is the formula we should necessarily judge how accurate the final formula used by Polaris is? It could turn out that this formula that Polaris uses actually is closer to the what the analyst would come up with by doing explicit cash flows. This is just yet another example of the art involved in doing evaluation and making reasonable trade-offs between accuracy and the loss of accuracy and the simplicity of a resulting formula. And I feel like with Polaris, the right balance has been struck, and at most it introduces a 2-3% error in accuracy, but actually that error could even be less depending on how you view whether this formula we're comparing it to is more accurate or not. I've already said the Polaris formula really puts the focus rightfully on the most significant term of the valuation formula, which is the second term that represents terminal value. And within terminal value, the two most important inputs are growth of sales and then future profit margin. But by far, growth of sales is even much more important than future profit margin. Usually that's from the Polaris site, that's defaulted for you. You can see the default value that Polaris uses for the future profit margin. It's usually a fairly reasonable default, but again, if you wanted to overwrite that, you can do it through this indirectly through the sales growth slider. But main thing you're going to want to really give some serious thought to is exactly what is an appropriate sales growth figure to use in your valuation. Do you use the default, or do you have some additional insight that you would then move the slider to a more appropriate growth, assume the growth in sales going forward? This importance of these two input values, sales growth and profit margin, was stated clearly by Gary Gray, who is a longtime professor at Penn State Wharton School of Business, in a book he wrote back in 1999 titled Valuing a Stock. He wrote, "The ability to forecast sales growth and profit margin is what separates the all-American stock analysts from their lower paid kin." So that's why PolarisInvesting.com site focuses on these two input values. The user can directly enter sales growth through the sales growth slider, and if needed, can indirectly enter profit margin through the same sales growth slider. All right, this has been a video on useful accuracy. Thanks for watching.